Welcome from me, Guy Monson, to our regular 6-minute strategy. Global equities last quarter offered a textbook case of markets climbing a wall of worry. The MSCI Global Equity Index is now back above the level on the eve of President Trump's Liberation Day on April the 2nd, and is very close to an all-time high. This remarkable rally occurred despite the highest US tariffs in nearly a century, 3 concurrent Middle Eastern conflicts, and direct US strikes on Iran's nuclear facilities. In more normal times, any one of these events might have sparked a surge in oil prices, a stronger dollar, and an equity sell-off. This time the reverse occurred, a high beta equity rally led by industrials, financials, and technology. So where do we go today? Well, we continue to favour quality, meaning companies with strong balance sheets, steady earnings, and high returns on equity. Why? Because tariffs can still rise further. Europe and Canada were threatened with 30% rates by the White House this week, while US consumers will eventually feel the pinch of higher import costs. China's huge manufacturing surpluses too may wash up on Europe's shores, weighing on prices and profitability. Let's see what all this means for portfolios in the slides ahead. So let's begin by looking at the state of markets in the left-hand panel. There you can see that extraordinary rally in global equities for a sterling-based investor, up from the lows of April 2nd, so-called Liberation Day, when Trump announced his tariff programs, rising back almost to a peak and passing a peak if you were a dollar investor. On the right-hand panel, you can see how the volatility in markets has reacted relative to history. You can see there the index bouncing sharply up to 50, that's the VIX, for the immediate announcement by Trump of tariffs. But look at the effect of other foreign policy issues. The Iran, Israel, and US conflict hardly caused a movement in the underlying VIX index, which rose to just 22, back to 17 today. And that makes a very good point that Trump's foreign policy tends to mitigate risk in many cases, while his economic policy often does the reverse. Let's look at how other assets have performed. Well, the dollar has continued its decline over the last 12 months, rallying a little bit in the last few days. Oil the same, climbing though a few dollars despite the increased OPEC plus production, could be because of risks around potential secondary tariffs on Russian oil. Where have the problems been? Well, the problems have been actually in the bond markets, and particularly the long end, where yields have risen dramatically, taking the UK 30-year gilt, for example, up to 5.4%. Very difficult for the government to fund it. In fact, in general across markets, bond yield slopes have steepened. That means that long rates have risen relative to short dates. Even in Japan, there in yellow, that puts big pressure in the future forward global earnings from FactSet are a growth of around 13%. That's steadily higher over the last few weeks and months. That's driven in part by a weak dollar, but also just by the remarkable resilience of the US economy. Even more surprising, in the right-hand panel, you can see share buybacks in the bottom quadrant there, rising to a quarterly record, showing the confidence companies still have to pay out earnings direct to equity holders. While the upper panel shows the extraordinary growth projected in world dividends, with a forecast of more than 10% for the year ahead. What does this mean for revenues overall? Well, I think one of the reasons supporting this is, yes, tariffs have been a potential problem, but on the other side, for US companies, the OBBA, or the One Big Beautiful Bill Act that Trump has just seen pass, gives some real stimulus to the corporate sector, particularly through expensing of many costs. Now, the white line is the impact of the OBBA positively, and the brown and the dark section is the impact of tariffs. And you can see mostly across industries, these broadly wash out. So tariff negative, OBBA positive. So let's just briefly look at 2 countries that are in the midst of all this. First of all, China, a very good GDP growth number that came out, above 5%, strong export numbers. But inflation there only just positive and still falling aggressively at the producer level, which is really worrying for company earnings long term. What's happening, of course, on the right-hand panel is exports in yellow to the US are tailing off. They're rising shortly in Asia. Now, some of these may be transshipment moves. And note also Europe, those Chinese exports rising. Again, that'll put huge pressure on corporate margins, particularly in the industrial and auto sectors. The other area to keep a watch on is the UK. Our inflation is still stubbornly higher at around 3.5% or so for the core level. That I think will come down quite nicely through the remainder of the year and into 2026. But the problem is those gilt yields again that I mentioned earlier. At around 4.5% for the 10-year UK gilt today, were above even the worst moments of the Liz Truss sell-off 3 years ago. So you can see the pressure the government's facing. And of course, it's got to confront taxes. And I showed just there for the economists on the right-hand side, just for interest, Britain's largest tax increase in budgets. And there's Rachel Reeves' October budget of 2024, bigger even than we saw for Norman Lamont. So the pressure to increase taxes further is going to be really a high risk point for the underlying UK economy. So let's wrap up. We're beginning to see some value appear in bonds as the sell-off grabs momentum, and we've moved to a neutral position in governments, but still underweight corporates. In equities, we're neutrally overall, but quite conservative and quality focused in our equity selection. In alternatives, we're holding our overweight positions in gold, adding some absolute return funds where the numbers have been good, and retaining some of our high-quality infrastructure plays. We've got a neutral position in cash with a long-term position against the US dollar. We think this US dollar depreciation has further to go. I hope that's wrapped up what's been an extraordinary time for global markets. Much better, I think, given the geopolitics than we probably dared expect. Thank you.